Hey, how's it going, guys? Welcome back to MentFX, and as always, I hope everyone's having a fantastic week. I hope everyone that's trading live is doing amazing, and everyone that's not trading live is always on the demo charts or backtesting, just working through their overall system and understanding where exactly they stand. We have consistently funded members month in, month out in the mentorship, so I'm really excited to launch the MentFX prop firm, which is coming very, very soon. And once that is out, it's going to be very interesting to see where the path of this YouTube channel goes in the future as we start bringing on more profitable members to speak with us, people that begin to pass, people that use smart money to pass, and see what kind of community we can actually get to grow. So thank you very much. I just wanted to take a second to thank you guys. And now let's get into the general talk of this video. So as always, with every video so far, what we've spoken about has really relayed the information of the importance of mitigation. And as you all understand now and should understand, mitigation is ultimately when price trades back up into a supply and demand zone that was formulated in the past, right? The last up move before the down move, when price trades back up into that zone and then moves away from it. Or even if it just trades back up into it and then keeps going higher. Either way, whether it goes higher or continues trading lower, doesn't really matter. We usually look for setups that are under the guise of this move right here, right, where we come into it and trade away from it. And the reason we mitigate, right, reduce risk, is because when smart money goes to manipulate the orders above previous liquidity, grabbing those orders with many buy orders, those buy orders usually exceed the amount that they can sell. So as they sell down, they sell into those orders, and as they sell, we are able to use imbalances and the beauty of multiple timeframes to see how those orders were mitigated and how price moved away. And that is why supply and demand zones form, and that is how we anticipate their mitigation and then continuation. So as you all know, if any of you have been watching EU on a higher time frame, you'll know that we've been in somewhat of a consolidation for a few months, or for like a month or two. It's been relatively consolidated, so there's just been a lot of inner structure that you could have been playing with, and there's been great setups inside of supply zones formed here, in the supply zones formed here, which did get liquidated with which then you used to get in, and now the newly formed demand zones, which we're looking to take to the top side or the ones deeper. But right now, the bias overall is to see it happen from these points here. Now, this is really normal. Not always will the market be delivering in these large moves and large sporadic moves like this. Sometimes you will be stuck in consolidation. Ultimately, what you guys have to recognize is that, if I can open this up, yeah. So ultimately, what you have to realize is usually the market is going to be a little bit slower in the beginning, usually throughout all of August, and then a little bit of September, near the end of September. So now in the next, basically until the 30th, we should start picking up momentum in this market, and we should start delivering in a certain direction in terms of price. And it's going to start picking up steam on the larger time frame. So swing traders, of course, know this. And now September, even through October, should be pretty liquid, and there should be a lot of movement. Now, as you all understand, because of the way we study smart money, the beautiful thing about what we do is these same dynamic moves that still end up giving you some entries, right? Like this break of structure followed by this beautiful supply zone, again, characterized by that buy before the sell. And just so you guys understand what I'm looking at here, because this might get confusing for new people, right? This is just multi-time frame understanding. You have that break of structure down, shifting that structure lower, putting in motion this protected high, and putting in motion this newly created liquidity low, where again, retail, hedge funds, and other people are looking to start trying to call the bottom of a market. The market trades back up into the previously established supply zone, shown by this last up move before the down move, the little wick, which you can see on a 2-hour chart. There it is, right? And why is it that this move is important? Because as you see how price moves away, we understand it again leaves behind an area of inefficiency, thereby showing us that the manipulation that occurred here to grab whatever buy stops were above these highs, and these highs with this move, as that grabbed it and they bought in to buy it and then sell into it, they weren't able to close all of those orders. That's why price trades right back up into it, comes to mitigate it under the same idea of weak and weak hand transfer, weak hand transfer to strong hand transfer, the shifts in new structure, and the delivery of price to newly established S&D 2.0 zones and the delivery to anticipated liquidity. So anyone that's in mentorship has been on top of this move. A lot of people that have even used the free content have messaged me constantly and shown me that they've been in this move right here. So that was fantastic for anyone that caught it, and that's great for all of you. And these are some of the larger moves that are going to be prevalent in some of these consolidations. But like I said, the beautiful thing about not being in a month, right? So as we understand, August and the beginning of September is usually a little bit slower, but as we get to the end of September and into October, it should start picking up the pace. The beautiful thing about trading the way we trade when we're in big consolidations like this is that these same moves that we see right here on that 4-hour chart, where we basically see a huge impulse down, the trade back into the prior unmitigated and manipulated candles, the supply or demand zones, in this case the supply zone, and then the continuation of liquidity occurs day in and day out on the lower timeframes. That is why I like to trade across the lower timeframes, because these movements occur nonstop. The only difference is that you have less pips to work with and you are on lower timeframes, which means that when you look to get involved, it's going to cost you more in terms of commissions for lots, but also you're able to get involved a lot quicker. What do I mean by that? Let's go and take a look at, for instance, a 15-minute chart very quickly. And we're just going to talk about this because last week, I believe we caught a lot of the moves in here. So ultimately, price begins to trade higher. This is just a random point that I'm picking right now. It is hindsight. If you guys don't want to witness the hindsight, join the mentorship and check out some of the live stuff. Otherwise, use this as content to then in the future get funded with my prop firm, and then all your analysis can be live and you can make money with your actual analysis. It'll be a win-win for all of us. Now, clearly we have this move here, this move of structure higher, and there's a few structural points that basically hold this move together. You have this structural point right here, right? So you have kind of this range established right here, and at the same time you have this range established right here. So there's kind of two structural points. The main ones is this higher low and this higher high, and then you also have this low and this high. So both of these actually function as a specific structure. So if we saw a shift of this blue structure, right? So if we saw a shift of this blue structure, which we see here, we can anticipate bearishness until at least the deeper demand zones in the areas down here, which are probably still unmitigated. That's why you can see this wicks in, moves higher before trading through it, right? So this is where a demand or a supply zone is actually going to act as a target instead of just as something that you want to look for trades off of. Now, I'm not going to go and refine this right now, but ultimately, why is it this becomes a target? Well, because in this up move and in this structural play from this red low to this red high, the market was manipulated lower, the sell stops were ran, and then the market continued to trade higher, right? And as it did that, we again operate under the assumption that inside of this area, those orders that were sold into before the buy occurred might have not been exited fully. So in the future, when price gets to that area, they'll be able to mitigate it for the purpose of A, continuing this red structure's move to the top side and continue to delivering to new liquidity on the top side, or B, use that area to redistribute into new lows, which, I mean, if we go to a lower time frame, you're probably going to see a redistribution in that area, which we can show you right here, right? So there you go. A beautiful redistribution, right? Comes right into it, begins to clear the highs, this weak to strong hand transfer, the continuation downwards, and then that structure on a higher time frame, which we'll talk about in a second, again, weak to strong hand transfer, the breakdowns, the test of the last up moves before the down moves, the test of the last up moves before the down moves. Similarly, on a fractal nature, we're getting those buys before the sells, the manipulations happening again. Why are they happening? They're liquidating the mini orders that are being put in by people on even lower timeframes or on the 1 minutes, because even people, even you as a retail trader, if you've ever gotten involved on the 1 minute, know how important emotions are and know how important management is. And as this move starts, there's a good chance that a lot of you started to trail your stop loss to this high, 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 then to this high. And this is that mini grab that might have stopped you out in profit, but allowed smart money or smart interests to continue overlapping their larger positions into their overall move, which was then continuing lower, right? So let's go ahead and delete all that very quickly and talk about the actual structure delivery here. So again, we have two main structures that we have to focus on. And if you're a little bit confused by this, check out my other videos or join the mentorship with the link in the description and the link you see below, where we break this down in a structured, in-depth, private course. Otherwise, pay attention. So we get this breakdown right here. And as you can see, as we get that breakdown, we need to ask ourselves, where is this move down coming from? And ultimately, if we notice, the last up move really is this all up move here, which we can again go and refine if we really wanted to. And I'm sure if we go inside of here, we can probably see some kind of refinement. So actually in this case, I don't really see a refinement that's good. There's probably a 30-second refinement in there. If we really did want to find it, we can try. I'm just going to show you guys really quickly what I mean by that. So as we speak about mitigation, we know that this whole move here ultimately bought up to take out all the liquidity in these areas before selling off, which means somewhere in here, there's a chance that smart money needs to come back up to mitigate the orders that they prior had to buy into to sell, that they might have not fully mitigated. Now we can view this mitigation as price moved down with all these little wicks, right? We can see how these wicks mitigated that area. We left a little imbalance here, an inefficiency of unmitigated orders, and price came right back in, liquidating other orders, fulfilling that prior inefficiency and continuing lower. So in this specific case, we can go a little bit lower. You don't need these lower timeframes, but I'm going to use it here just to see if I can refine the zone a little bit further. And there we go, right? So in this case, we do have this up move. And now if we follow along with the price, you'll see that we move down, create this imbalance from this wick to this wick. We come and tap into that imbalance ever so slightly, creating a miniature liquidity grab, which again, you have to recognize, there's not people on a 30-second chart moving their stop here. But what's happening is algorithms on behalf of huge hedge funds, huge institutions, as they're getting involved in hedging positions, they're also moving stops really aggressively all over the place. This is how the market operates. So this mini grab here is still grabbing some kind of liquidity that is resting right above these highs here. Right? And who knows, maybe there is some retail trader that's watching for double tops right inside of here. Either way, that's grabbed. So we can look at this wick as a mitigation of this prior area. So even though this is valid still for price to come trade back into it in the future as a form of fulfilling the unfilled orders there and continuing lower, aka mitigating those positions, we are going to pay attention to the newly established story. Now, if we keep following it, we then get this move down, which breaks structure and then trades right back up into the last the last supply zone up here, and then breaks down impulsively. As it breaks down impulsively, it leaves behind this last up move before the down move, which is mitigated by this next candle, which we can now refine to this zone here. And now if we draw this out, we'll notice that even though it had a little bit of inefficiency here, some of that inefficiency was fulfilled. However, the actual bulk of that supply was not, which is our first telltale sign that there is a good chance that in this area, we can make a deep reach into at least here to fulfill whatever orders were left unfulfilled or unmitigated during this manipulation of the liquidity here and here higher, right? So now what we're gonna do is we're gonna zoom back out to the 15 minutes so we understand where we are. And this is all this is based on is on that first structural shift of this blue structure. And again, what does that mean? That means that now the only expectation that is left basically running is that price is going to make a move up into here. And if it does, we can expect that distribution from this price to actually make its move to where? Let's actually draw this out again. Let's make it blue. Well, to the next liquidity point, because we understand that when a trend is developed and a trend is in motion, the liquidity in the market exists at the lows, because at all times, there's always going to be an argument for a reason that people are buying here, moving their stops here. Some people bought down here, some people bought here, some people bought here, here, here. Retail is always buying in some area. They're also selling. There's retail traders that are getting into sells here off of this resistance, right? There's constant buying and selling in this market. But right now, because of the specific structure shift we're looking at, the expectation that we are to have is that the next move, if we get a move into our unmitigated supply zone, is to come and move into the liquidity that exists right here. Right? So under that assumption, if we even view this, there's retail that's buying this trend line or waiting for even the third touch of it. There's people or retail buying this trend line right here, which is now working perfectly. And this is, their pin bar little pattern that they're going to use to get involved. There's people looking at this as an overall support and resistance area. And they're seeing this basically, this not mitigation, but they're seeing this, what's it called? they call it what, failing to go lower. They're seeing it respect the zone, so they're looking to enter the buys on that. And again, they're not just watching it on a 15-minute, as we always say, they're watching it on a 1-minute. And especially here, if we begin to trade higher, then a lot of retail is going to begin. So let's see if we do. Yeah, so we do start to trade higher. So as we trade higher here, yep, there we go, a lot of retail begins to shuffle into those buys here. And as retail shuffles into those buys, clearly, where does their stop loss go? Let's go back to the 15-minute. As you all understand, especially if you've been a retail trader, you're coming from a retail perspective, as that trades higher, which we know it does, everyone's looking to buy that 3-touch trend line. The support become resistance, the over time nice little support, the new channel being established by, you know, this line and this line, a whole myriad of factors that you can use for why retail might be buying. This is why I don't really subscribe too much to the retail way of thinking, because there's not always a systematic way you can approach it, and sometimes it can be really like, oh, it might be this, it might be that. And smart money is similar in a sense, but there's also a lot of discrepancies and differences, and that those differences come from your understanding, which again, if you don't really have right now, or if you're confused, make sure you check out the rest of my channel before leaving a hate comment or something, because I really do try to get a lot of this across to people that, you know, are willing to subscribe and take the time. So just going back to this overall mitigation, again, we understand that the last unmitigated zone was this one right here, and we could even include the one right here, just because we understand that this was still an area that had that buy to sell, and as those sells occurred, we basically failed to mitigate up inside this area. So we left an inefficiency here, right? Especially like this is still an inefficiency here, even though it got filled a little bit. And we left, like we said, even though it got filled a little bit, we still left this inefficiency here. So I would still leave this overall area. Maybe you could refine it to something like this if you were to refine, because remember, now we're looking at a 15-minute. But what's interesting about this move here is that if we're using the lower time frames to get involved, this same entry here that's going to run to this liquidity right here is the same as that daily time frame. And instead of waiting, for instance, for the end of September into October to get that big movement in the higher time frames, we are able to catch very similar moves on the lower time frames because the market is fractal. I actually do the same thing with 1-minute charts usually during the day, and a lot of people in the mentorship are used to doing the same thing as well. So let's talk about this specific entry. So we have these two main POIs. We can really kind of get rid of this if we want to. And you can always go for the one that's further out just to increase your likelihood, right? Because price can mitigate here and drop down, or it can come a little bit deeper into that last buy before the sell, the last supply zone that still has its inefficiency, right? Mitigating those manipulated orders and then take that price lower. So in this case, we can have that open. And we can see how price responds. And at this point, you know, it's perfectly valid. I myself don't get involved like this, but it's perfectly valid to have some positions open or just to have one open at this area here to get the best possible entry. But if you are to buy a lower POI or sell a lower POI, and again, this is not financial advice, I would always suggest that you use the stop loss of the higher one, right? And you're always going to add 1 pip just like that, or like a little bit to account for spread. And to account for full mitigation. And if you have a low pip spread or like a 0 pip spread, then that's great. It'll never get tapped on your sell. But we're not even going to talk about that right now. Factor your spreads. If you're losing money and you're not profitable because you're not factoring your spread, then that's a really dumb way to lose money, and you are actually a profitable trader, right? So we'll have both of these drawn on here, right? And we're not gonna get into the deep confirmations that we usually do. So in the mentorship, we actually would be confirming both of these zones to go short, and those confirmations are in the form of double ment blocks, in the form of Wyckoff, which we get involved in and talk about deeply in the mentorship with multiple entry criteria confirmations. So if you're interested, feel free to join. Otherwise, again, stick to the process. So in this case, all we really care about is this blue structural shift that we're now looking to deliver to this next liquidity lower. And remember, we don't really care what's going on with retail because retail is just in the way of smart money. Ultimately, you have to recognize that we are 5% of the market. We trade very little. We really matter. Oh, okay. So that actually came up instantly into there. We matter for very little in the market. We are tiny, tiny fish. Retail accounts for about us traders account for 5% of the market. We are nothing. And when retail is looking to buy, for instance, all these support zones or all these trend lines, the only reason they're losing is because they're just getting in the way of what smart money was going to do. And this psychological delivery of price is going to lead them to believe a certain thing about price, right? Because even as a retail trader, if you watch this price during this large impulse, This is big momentum for you as a retail trader. And if it's a third touch of a trend line, as well as a prior support trend resistance from the past, and you're seeing this type of movement, there's a really good chance that you're looking to buy into this move and place your stop loss here, which, as you see now, becomes our liquidity as smart money, because all we see is that structure has shifted to the downside. This structure has shifted, the blue structure has shifted, the red structure is still being developed, but it's still, if we go find the red structure like we were talking about earlier, the red structure is still at these points here, right? And all we're really looking for is for that shift to occur to begin to shift lower, at least getting into the demand zones down here. So if we zoom in again, right, you're seeing that happen right there. Again, the target, the first target kind of becomes this one. You can play around with the way you like to risk manage, but it's perfectly fine to, as a starter, start with an 80% partial at these levels, right? So you can partial 80% and let 20% run, because in the case that this move, for instance, wants to keep running, you get your 80% partial of a 1 to 10, and then whatever it wants to run to, you know, anticipating that it could even run to this liquidity here. If it does, that 20% left on the trade runs another 1 to 52, which, you know, isn't actually 1 to 52, but that 20% becomes worth another 10.4 RR, right? Which is huge. If you're risking 1%, that 20% you left on makes you an extra 10% on the account, which is insane. Now, I don't risk 1%. It's too much for me to risk, especially on my very low stop losses, but that is how you can approach it. So we're going to get rid of this second position, just because we did say that we could have a deeper mitigation too. Both are valid, just so you understand, but I would still be protected across that high, and price should deliver to that liquidity now. And there's where the stop losses of poor retail that might have gotten involved on this, that we're looking for the buys off that, off the break and retest, off of this new break and retest right here, right? So they're watching this right here as a break and retest as well. And then after they see that wick, they think that, you know, maybe the bullish market is back in motion, without viewing where the actual structure is moving. So now again, our anticipation is that we're probably going to deliver to those points down there, which we can start to refine if we really wanted to. Here we go. And as we begin to deliver lower, so let's get rid of this 80% partial. Let's get rid of this. Let's get rid of some of these so you guys can see what I'm looking at here. There we go. Right. And as we do that, all we really care about is, here we go. Let's get rid of all that. Move back over to not where we were there. There we go. Okay, great. So let's move back over here. So again, as this price begins to move, it's clear that I probably would have been stop break even here. I would have been at break even when price was already like here. Profit would be already hit at that next low, which was here, right? That was that 1 to 10, I believe. Yep, 1 to 10 right there. And then it ran straight through that low. And as it did that, what does that do with that red structure? Well, it shifts it again. Right, so that red structure shifted again. And again, I ask you, where did that red shift come from? Right, so if we just take a look at this really quickly again, and I know it's hindsight, I'm fully aware that this is hindsight, but this is all for your own understanding, and this is what we do every single week in the mentorship, and this is how I've created consistently funded full-time six-figure traders in the mentorship nonstop, and even over the free content, right? Just subscribe to this way of trading, of understanding, and begin to journal it and just allow it to play out and see what happens. Okay. So again, as we see this breakdown and the new red structure is put in place, we need to understand where that came from. Well, where's the last up move before the down move? Clearly there's one right here, right? So there's this last up move before the down move that was inefficient and left behind. And at the same time, there was this one right here. So similarly, on that higher time frame, if we go to a 30-minute, you can see the same thing happening. We could even refine the zone to that last wick, right? And this one, we can leave that same way. And now, again, you have the same idea. But now, as you increase the time frame, you still have the same setup. It's just larger. Right, and in this case, it's a little bit worse because you can't refine it. So actually, we're going to go and refine this to try and get a better criteria. So in this case, when your stop loss is much bigger, you can consider protecting across this high. But let's go and see if we can potentially refine this. So yeah, as we get lower, we can refine clearly to this. Let's make this smaller. There we go. To this last up candle before the down move, right? So this whole thing was an area that we understand was used to manipulate all these highs before price went lower. And now we're looking for it to tap in and go lower. But we also understand that within that, there are new mitigations that present themselves. And because we're able to play with time frames, we're able to see that during this manipulation and this move away, not only did it create that supply zone on that higher time frame, denoted by this overall area, but it also created this very, very small one right here, which means that, again, this area here is unmitigated orders that could see that mitigation to go short. And again, you have two things that you need to keep in mind. You have a target, the liquidity right down here, right? And you have a S&D point, this area right here. So what we'll do is we'll protect ourselves to that one now, right? Thereby increasing our RR on that overall trade, just like that. And what we'll also do is we can take a look at what happened inside of here. And clearly this is all mitigated. So we could actually protect ourselves basically just above this high. Now, I actually don't know what happens here. I think it might actually lose. I'm not 100% sure, but we'll take a look. And again, we're gonna go 1 pip above, just like that. Not 1 pip, 1 pipette above to account for 100% mitigation. And again, if you have larger spreads, you're gonna have to increase this by a little bit because you need to understand that if price is here, the spread will actually be here, right? So you need to account for that type of thing. But in this case, because this is hindsight and we're just showing it in terms of this price, we're not going to account for that spread. But I always suggest that you account for spread. So what we did is we refined it, right? Now what's interesting is price can trade up, and this is something that people need to recognize. Price can trade up and mitigate this open and then go short, and you're going to miss that trade. The perks of understanding refinement and understanding where mitigations can occur and refining to those areas is you get much better RR, right? You can get a much smaller area to confirm Wyckoff in because it's normal, and you've probably experienced this. If you have a large area, price can come, have Wyckoff, go short, come back up, liquidate, have Wyckoff again, have it one more time, and then go short. Right? And then you might have a few losses before you hit the actual home run that begins to run. But if you're able to refine this large area, denoted by this large rectangle, to this tiny area here, which could be this, the only entry you're looking for is this one, because that's the last mitigation that's possible in that area. And that's what you do when you do something like this, right? So in this case, all we need to worry about is the fact that this is that last mitigation. What we'll look for is for price to come and tap into that and then go short, right? And then we can play that out. I don't know how this works. Okay, nice. What the fuck? Oh, okay, nice. Okay, well, either way, so what you see happen here is, again, that same delivery that you're going to see on those higher time frames that may take longer to unfold, as you will on the 15, the 5 minute, the 1 hour, the 30 second, the 15 second, the 1 minute. This is what it means when you hear people say the market is fractal. What a strategy should be able to do is it needs to be able to be dynamic enough to be used across timeframes. And the beautiful thing about a strategy like that, like smart money, is that you're able to fine tune the rules to your own personality, whether you're someone that wants to be in the market and out of it quickly, whether you're someone who wants to be swinging it, intraday scalping it, whatever it might be. But the main thing that I want you guys to take out of this overall teaching is that mitigation occurs at areas that have inefficiencies left behind and are in movement and are in mode with the structure presented. And this will happen across every single time frame. Whether you're on the daily charts and you're watching for certain daily breaks that are going to continue, right? So if you have this structure and it breaks and you're now, what are you looking for? That liquidity continuation on that structure. Right? Now, this is not always going to work, but this is how you preset a bias and then allow that bias to create entries for you that then have the possibility of running RRs that, might seem uncanny and unbelievable, which is why I don't really share many of them. Because I don't want people thinking that I'm here just to teach you how to get the highest RRs, which you can do. You can get very high RRs, or you can trade with 1 to 2, 1 to 3. I've had people in my mentorship that trade 1 to 1s, 1 to 2s, and are profitable with FTMO and everything. And I have people that trade 1 to 80s and take a string of losses before they hit them, but are able to do it profitably as well. And once the fund is live, it'll be amazing to see where the course of this channel will go, and to see a lot of you take the education that you've been given here and actually transform it into something that's real, powerful, and part of the mentfx community as is. So thank you very much for watching, guys. I hope this gave you a better in-look at structure and mitigation put together. And again, to wrap it all up so there's no question and no misunderstanding about it, mitigation is the closing of previously manipulated orders in the market. That's basically it, right? This move here, the down move before the up move, needs to be mitigated. That mitigation, that we had here is going to be met with price that now wants to either A, accumulate to new liquidity highs or re-break back down. But you're going to notice that these higher time frame areas are almost always going to have these mitigations that come off of them, because there are so many orders that they required to manipulate this price and weren't able to close them all. And you can view that inability to close all the prices across timeframes. And because you're able to view that, you're able to sometimes amply predict exactly where a certain movement is going to be refined to and move from. You're going to be able to, again, predict and refine where a certain entry may come from, right? Remember this entry here, all it was a refined area up here. What was this entry here? A refined area up here. Instead of using the entire supply zone, we were able to refine it down. So again, use this information as you will, continue to learn, look forward to the prop firm, and when it's out, I want to see you guys kill in on the markets. Thank you so much for watching my video. Leave a like, subscribe, whatever you got to do. I appreciate you guys a lot. We're at like 41,000 subscribers, so you guys have been crazy. And I will see you guys in the next one. Thank you very much.